I'm requesting Gigi sir to start the नहीं अब मेरा uh, yeah, good afternoon everyone. Sorry for the technical glitch. Thank you very much for joining today's webinar. I'm requesting Gigi sir to start the webinar with his welcome address, and we don't want to waste much time.
Thank you, Sri, and good afternoon to all. My heartiest welcome to each one of you for this today's webinar on a very, very important topic, that is regulatory compliance. I'm sure each one of you will be very much interested about this particular subject, because this is something of a lot of importance for all of us. And we have been also seeing that if there are regulatory compliance breaches, RBI also come very strongly, very sternly, and they also impose penalties. So compliance is an important thing, not only for the purpose of satisfying RBI, but also for the proper functioning of the organization. Compliance becomes very, very, very important. So when we talk about compliance, there are several compliances are there. Regulatory compliance from the RBI is there. There are compliances on other matters like PMLA, that is money against anti-money laundering. There are state level regulations are there, central level regulations are there. Now, of course, you must be also aware that recently the government of India has come out with a 4 set of codes, labor codes. So that also becomes a compliance for all of us. So there are several things we need to comply on. In fact, I remember someone was telling it is more than 100 things we need to comply with, and organizations need to comply. So it could be much more than that, I believe. So we have to be aware about what are the things to be complied with, and how do we comply, and ensure that we are at the right side of the law. So for this purpose only, we thought of having this webinar. In fact, last year also we did a similar one, and there was a lot of demand from the member side itself that we should organize more such webinars. That's the reason we organized it. So I hope today's discussions will be very, very useful, and it will benefit each one of us. I especially thank and welcome Subrat Pradhan and Suresh Kumar. Subrat Pradhan is the Chief Compliance Officer of Annapurna, and Suresh Kumar is the Chief Compliance Officer from Ashirwad. So both are very experienced persons. I'm sure their knowledge and insights will be useful to all of us. And with today's discussions, I am sure we will be much better positioned to ensure that we are at the right side of the law. So with this, once again, I thank each one of you and welcome each one of you for this for joining. And I thank my team, Chandan, Sri, Nandi, Vineet, and Sunny, who organized this. I'm sure more such thematic webinars will be organized in the future. Thank you once again, and welcome each one of you.
Thank you, sir. Thank you. Before we start the webinar, I'm requesting everyone kindly put yourself mute if you are not talking. We'll have an open house discussion after the speakers deliver their points. Now I'm requesting Mr. Chandan Thakur to give the presentation on the cost of compliance.
Yeah. Thank you, Sri. I hope I am audible. Good afternoon, everyone, and welcome to this webinar. We all know the importance of compliance in microfinance, in NBFC, and all the regulated entities. We keep, engaging. We keep communicating with various departments of RBI, whether it's Department of Supervision and Department of Regulation and others. So today, I will take you through a brief PPT highlighting the cost of non-compliance, not only monetary, even beyond monetary as well. Sri, can we have the PPT, please? If we just enlarge. Yeah, thank you, Steve. So that exactly we were discussing. The cost of non-compliance is not only the cost to your institution; it was also cost to the sector at large. So how it impact, the cost of non-compliance? We comply mostly the partial compliance. I think that is something we come across very often from various regulated entities that the partial compliance is there and it impacts us. We know there are some visible impact in the form of penalty, fine, warning letter. There are various, unvisible hidden as well, like lender withdrawal, rating downgrade, brand damage, regulatory action, borrower exodus. At Sa-Dhan level, we keep sharing at quarterly level the kind of penalty RBI impose on regulated entities that vary from compliance issue, customer protection, risk management, governance, but the maximum issue, maximum points come from the compliance side. So that is something quite important for each one of us. Yes, moving next. What our members, the regulatory entities, are supposed to do in terms of complying with the guidelines and the compliance obligation. RBI master direction. This is something we all are aware of. Sa-Dhan being an SRO, we have had lot of webinars. We keep communicating with our members to just stick with that, just follow that. That non-adherence is quite important on the RBI master direction. The industry code of conduct. Even last financial year, we have organized lot of webinar training workshop for our field team of different MFIs on different aspects of code of conduct. This is really important, particularly in the challenging time when we all are, coming back from crisis of 2.5 years. We have witnessed the challenges in the key states like Tamil Nadu, Bihar, Karnataka, and others. So it's important to stick with the code of conduct. Similarly, with the fair practice code of RBI, as a transparency part and pricing charts, and when we interact with the RBI is quite clear, quite focused, and quite particular in terms of their expectation. They always stick on the transparency side. Overall responsible lending that includes credit underwriting, grievance redressal, and recovery conduct. And we know RBI nowadays, recently RBI has sought feedback on conduct of regulated entities in recovery of loans and engagement of recovery agent. This is one area which RBI is quite particular. Grievance redressal. This is equally important. We have come across during our interaction in different regions, particularly in the northern India and eastern India. The borrowers are not aware of the grievance mechanism, grievance redressal, how their issues will be addressed. Data reporting norm, QMR submission, CIC bureau reporting, that is something we expect all our members to submit, provide data to SRO to Sa-Dhan on quarterly basis, the detailed data as well as on CIC bureau. Recovery conduct, that exactly I was referring to, no coercive recovery, staff conduct standards and all. Moving to next, not all violations are equal, but all have cost, both monetary as well as non-monetary. We have categorized all sort of non-compliances in 6 categories. Two are of moderate risk, two are of high risk, and two are of critical risk. Reporting failure, KIC documentation, these comes under moderate risk. If you go beyond defense gaps and over-indebtedness, that is of high risk, of course. And critical is recovery misconduct, mispricing, and hidden charging. RBI has recently come out on a clear framework on mispricing, and that is something that's why it comes on the critical risk. So this is to categorize, to prioritize our work in terms of the compliance part. If you go on the next slide, please. The cost stack, direct cost, since we are discussing about cost of non-compliance. So there are a lot of cost involved that are when RBI had issued enforcement orders against NBFC and MFI for violation of conduct, including non-disclosure of pricing, coercive recovery, KYC norms, and suppression of CIC. SRO advisory notice and warning. This is something we keep doing at regular interval and as and when required. Regulatory show cause notice that requires management time plus legal cost. We are talking about the direct cost. It could be of direct cost for non-compliance, RBI enforcement orders and penalties, legal costs, recovery complaints, consumer forum, NBFC ombudsman, compliance remediation cost, process redesign, staff retraining, CIC correction, and resubmission. In the next slide, we will discuss about the indirect cost of non-compliance. Hidden cost to your institution, lender confidence erosion, higher cost of fund that leads to higher cost of fund, credit line suspension or covenant breach trigger, credit rating downgrade, co-lender, EC relationship termination, tighter covenant or failure facility, top future facilities. The indirect cost doesn't restrict to your institution. It goes to the sector as well. That is systematic cost to the sector. Sector-wide regulatory tightening, borrower trust deficit, political and media exposure risk. We all are aware that we are quite vulnerable to external risk, particularly the political power, media thing and all. Reduced capital market appetite for the sector. Credibility issue. So these are the indirect cost to the sector for non-compliance. Next slide, please. How the SRO responds to non-compliance? Routine monitoring, that is something we keep doing, ongoing on-site review, CIC data checks, thematic inspection. We have our mechanism and we keep doing on that part. Advisory guidance, we keep issuing advisory, precautionary advisory, guidance note to just bring in the notice of our members or the regulated entities, corrective actions plan requested, formal notice and directed remediation, suspension and regulatory referral. But this is something as an SRO we always vouch that for SRO our primary objective is remediation. That is something we always focus on. Moving next, please. Your funder is watching too. This is a new evolving, evolving parameter that we are witnessing across the sector. Most of the lenders, public sector bank, the leading DFI, development finance institution, they routinely require SRO compliance certification as a condition of sanction or renewal. Non-compliance is no longer just a regulatory problem. It is a creative risk flag that impact cost of fund, covenant breach, credit line loss. So, and we all know funding is quite important. And for last 2.5 years, we all have been trying hard to ensure to facilitate this, liquidity in the sector. Moving next, please. Non-compliance as a human cost. This is really important. The borrower dimension, often the last to be counted, always the first to suffer. The microfinance sector exists on a foundation of borrower trust. Systematic condition violation erode that trust. And that is really important for us. When MFI, when microfinance institutes cut corners on grievance redressal, overlending without proper assessment, or deploy aggressive recovery tactics, borrower bear the cost first. What we have witnessed in last 3 years, from financial year 23 to financial year 26, complaint from borrowers has gone up 1.8 times. That is huge number. 70% of borrower grievances related to CIC and insurance delay. That we know that is a quite common and that's quite prevalent. That is that. And the third point, 1 in 5 borrower have no awareness of a GRM mechanism. That exactly I was referring in the beginning. That is more on the sensitization part. And that we know, being an SRO and all our members, we keep doing how to sensitize our borrowers on various aspects of compliance, monitoring, regulation, responsible lending, responsible borrowing, on all those aspects. If you go on the next slide, please. Yeah. The flip side, of course. The compliant MFI attract better capital on various parameters. It could be cost of fund, lender relationships, credit rating, regulatory posture, and sector standing. The MFI which are non-compliant, they suffer on those parts, and the compliant MFI always they have the benefit. They have lower stable strategic on the cost of fund, good lender relationship, and good credit rating. That really helps the institution and the sector at large. Moving next. What the SRO asks of members. Again, it's consistent, rather complicated. Compliance with RBI, SEBI, and the Company Act, and timely data submission to SRO and CIC. This is really, really important. Maintain a functional grievance mechanism. We come across many cases where we get to know that the grievance mechanism is not working, not functional. adhere to exposure and pricing norm. This is something RBI is quite particular, and we all are. We just need to focus on it. We just need to adhere on the guideline. Train frontline staff on the code of conduct. This is equally important because they are the frontline staff, play the pivotal role, major role at the field, at the ground, and engage proactively with SRO monitoring. This is something we always request our member to engage with us, support us, and let's find out the solution if there is any challenges at the field and something. Moving next, please. The choice is yours. The SRO exists to protect members as much as it exists to protect borrowers. Compliant members are insulated from sector contagion, regulatory overreach, and lender panic. The architecture of oversight is designed to reward consistency. So compliance is not a cost center. Non-compliance is the choice is yours. So I think with this, I will conclude my presentation here, and we'll go to the next agenda where we have some really good resource person in the form of Mr. Subrat Pradhan and Mr. S. Suresh Kumar. Thank you so much, and thank you so much for carrying out. Thank you. Over to you.
Thank you, Chandan. Thank you, Chandan. Thank you for the detailed presentation. Now I am requesting Mr. Subrat Pradhan, Chief Compliance Officer of Micro Annapurna Finance Limited. Sir, please, I'm handing over the session to you now.
Thank you. Thank you.
Sir will discuss on the recent changes in the regulation.
Thank you. Thank you, Sa-Dhan, for giving this opportunity, and hope I am audible to all.
You are.
Yes,
You are.
And really, this organizing the webinar will help us to discuss on the issues that for the compliance we are facing in our day-to-day operation process. As you all aware that most of the regulations RBI has moved from prescription to policy level, which leads more ownership on the board and management, that you have to frame your policies and basis that you have to function. Although it's give you opportunity to design your products and process according to you and lending practices, it also gives the ownership to have this. And with this policy-based approach of regulations of RBI, it will also help you to strengthen your risk management process also, because you are designing your policy and basis that you are practicing that. On the other part, apart from regulations, we all are facing inspection also. And in the recent RBI inspection, they have moved their approach of inspection also to, all over that from quantitative to qualitative. So there is no such kind of set standard which they will satisfy to your compliance level. So they will give you always they will try to improve you through inspections. So their observations are more or like nowadays in the qualitative forms. So at each level, you will have the scope to improve your compliance level. I have a short presentation also on this, on the regulatory changes, which topic was assigned to me. Hope my screen is visible to all.
Yes, sir.
Thank you. So basically, this presentation consists of the most of the recent changes from last year to till June. All you're aware about the last two major changes, which are 60% of the total asset on the qualifying assets. So this is not a by mere changes. It's allow us to maintain liquidity in hand. We can by these changes, it will allow NBFC to have more cash in form, so that they can play in their ALM positions. They can diversify into the other non-MFI category. This is a major scope which RBI has opened up for us. Please do let me know in case where I need to pause or any question on this, any kind of changes, or you want to discuss in more detail on that. Otherwise, on the minor piece, I'll skip that. This is the new regulation, the prepayment charges for floating rate loans. Most of the MFI don't offer floating rate loans, but in case they are offering any floating rate loan, then be aware that they cannot charge any prepayment charges on the loans. So whenever there is a rate revision, most of the MFI, though, as a practice, do the rate change on the prospective basis. But in case they are doing any retrospective change on the existing portfolio, then this may come into picture. Coming to the grievance part, since RBI is most stringent on the customer protections in across all the regulations. So the new addition is that they require to review all the grievances and type of grievances at MD or CO level committee kind of thing. So each NBFC has to do the review that what kind of grievances they are receiving from customers with particular, if you need their geographic, particular geography from where they are getting major grievances and what kind of grievances. So they can do the root cause analysis and present that to the MD and CO and then to committee. The next change is the co-lending arrangement. So as you all aware that RBI has previously prior to the circular, there are two arrangements of the co-lending on CLM1 and CLM2. Now they have discontinued the previous one, and now they are allowing only the CLM2 model, by which both of like there is stricter compliance in this CLM model, in which in case you are going by co-lending, you have to in the KFA statement you have to declare things on the co-lending partner, blended rate of interest, and all other details. Although it will get a window to this MFI for getting partners from banks and other NBFCs. Coming to the next change on the, this is not from the RBI, but RBI notification and the Supreme Court notifications, in which they have prescribed us that for the person with disability, you have to first they give sufficient platform for the person with disability. That one is that whenever you are introducing any kind of product to a company, then that should be feasible to that company. Then you have to give the platform for raise grievance by that persons. So you have to take care of those also. So basically, there is no such standard practice they have prescribed, but as much as possible, we have to accommodate for the person with disabilities to accessing financial service. It may be application of loan or execution of the documents or raising a grievance to the company. Again, coming to the change in the KYC amendments, CQAC, hope I believe all the NBFC are using. For the CQAC, although the exemptions for SSG and GLG is still continuing, are we insisting uploading CQAC document for the individual loans? And also they are insisting to use CQAC record for re-loan also. Of the second loan, instead of going to a fresh KYC, you should use the CQAC data also. And now they have add on on us is that the NBFC have to update and upload the KYC record, and they are the responsible to verify the identity of the address of the customer. So you have to verify the correctness of this data that you are using or uploading in the CQC portal. Coming to the Internal Ombudsman Direction 26, now they are proposing to appoint deputy internal ombudsman also, in addition to the internal ombudsmans. So in the absence of internal ombudsman, deputy internal ombudsman can take charge of the issues. Then again, on the categorization of complaint, they specifically very focused on this categorization complaints. And I believe that this change they have suggested from the past experience they have drawn from the various inspections. So most of the things, all companies, NBFC and MFI are using telecaller to receive complaints. And because of that, through telecallers, it's sometimes the MFI categorize complaints as a query and not recording that in the proper register and giving resolution to that. And I think this is the outcome of that only. Moving to the next CIC reporting amendments, mandatory reporting to CQC is now mandatory. Then wherever there is a rejected data on the uploading, like in the CQC portal, you can upload bulk data also. So, and they submit a rejection report also. So in case you are getting a rejection report on the CQC data, then you have to resubmit those informations. On the ECB front, they have liberalized the ECB availing framework. I request all the NBFC MFI compliance had to review that, reread that ECB guidelines. They have eased lots of things as compared to the previous ECB guidelines, so that they can tap to the ECB market for the borrowing. including raising of limit and relaxation on the minimum maturity and all. Going to the next modification on the prudential norm on the capital adequacy. In the free reserve Tyron calculation, Tyron capital calculations, now they allowing quarterly profit to add on, so that it will help you to leverage for the borrowing. And in the proposal, like in the bank proposal or borrowing proposal, you can mention the last quarterly profit into the calculations, which will strengthen your positions. Moving to the next on the resolution of stress assets. Now this is again as compared to the previous regulations on the resolution of accounts. Earlier there was a stricter regulations which prescribe a higher provisioning for any kind of resolutions in case any NBFC is doing. But in this amendment, they have eased that. So you can do that resolution any stress account which is impacted by calamities, and for which you need to provide only additional 5% of provision of the total outstanding which you are doing by the resolution framework. For that, you need to establish a scheme kind of thing. And the major benefit is that from the date of calamities to the implementation of the resolution plan, you need not to classify that account to NPA even if that customer is not able to pay that money. So you can, in case you can mark that account as a standard account, and you need not to do the provisioning as per the DPD criteria. This is the continuation to that. Then this is a stricter guideline on the NBFC on the responsible business conduct, in which they are like restricting or demotivating engaging of any kind of advertising or marketing or sales of product, like new regulatory concept like such dark pattern, mis-selling, explicit consent. This has to be take care in the loan execution process. There should not be any kind of pre-tick in the application form or loan agreement, so that by default that customer is choosing that products or particular service. So it has to be explicitly mentioned in the documents. And please take care of this. So this is a non-compliance as compared as per RBI, and it can trigger to penalization. Same for the on the undertaking of financial services, in case you are engaging any kind of agency business or any third party for selling of these products. So be aware that in the agreement you have to explicitly mention what kind of responsibility you are passing on to that third party and you are taking. So basically, in total, it's the responsibility of the NBFC only to ensure customer services, even if you are engaging any kind of third party. So be careful while you are engaging any kind of third party for selling or distributing any products. This is on the prudential norm of capital adequacy, in which that in case your portfolio is covering through any credit lines, you need not to give weightage to that asset, which allows you to free your capital risk asset. And by that, your Tier 1 capital position will improve in case you have any credit line guarantee scheme and under which you have your portfolio. So these are the, please do let us know in case any items or any amendments which you people want to discuss in more, or else thank you for this opportunity.
Thank you, Mr. Pradhan. Thank you so much for this detailed understanding of the changes in the regulation. There is a small question from LOC. We can take it in the open house discussion later.
Sure.
Since we don't have much time now, I'm requesting Mr. Suresh Kumar. Okay. So there is one specific question from LOC that if they do not comply with qualifying asset norm, so what their question is, if our company has not fully deployed the capital and not yet met the qualifying asset percentage, then what are the consequences? So if you can
basically on the like compliance of the qualifying assets, since already you have a license, so technically they immediately they don't take any kind of action on that. So for the qualifying asset, in past also there are multiple organizations, they are not qualifying to that, including that during the changes to the net asset to total asset also. So each time RBI asks for a remedial plan. What are the remedial actions we have, and what is the uh, mitigation plan the company is proposing? So basically, and with that, they allow time to carry out the action plan. So in case you are not complying any qualifying asset for a consecutive quarter, you can submit a mitigation plan by what time we can comply to the qualifying assets. And that is broadly accepted by RBI. They allows the time to they have allowed to multiple NBFC also. So I believe they will consider in your case as well.
Any other question? I think Hetri has already uh, said the thanks. So it's answer Hetri's question. So any other question on any of the changes? Anyone wants to um, share now? Please do one thing, put your questions on the chat box so we can answer it later then. It will be
Just to
easier
add here
for
that,
us.
just to add here
Now,
that, don't ask for only extension. Give with a mitigation plan so that it will help actually. Yeah, please continue.
thank you, Mr. Shubhrat. Now I'm requesting Mr. Suresh Krumar to share his insights on the challenges of implementing these changes and what are the possible solutions for that. Sir, the session is now open for you.
Yeah, I think my slides are visible.
Yes, sir.
Yeah, first of all, I should thank Gigi sir and the Sa-Dhan team for giving this opportunity. Actually, like SRO's roles are very, very important because, regulations are changing at lightning speed. And, for each and every MFI to adopt it the
So you're
timeline.
not.
I'm not audible?
For last few seconds, could again repeat.
Yeah. So the challenge is that for each and every MFIs, understanding, reading, understanding, adapting, and implementing the fast changing regulations is a big challenge. And that is where the SROs can play a vital role. Apart from that, the SROs, you are our lobby. So whenever we face difficulty in a particular regulation or statute, we are looking upon the SROs to understand our difficulties, discuss, arrive at a common action plan, take it up with the concerned regulator or statutory authorities, so that we get a clarity and we get a resolution. In that context, SROs are very important, and the role Sa-Dhan plays is remarkable. Thank you very much, Sa-Dhan, once again. Today, two speakers, Mr. Thakur and Mr. Pradhan, were speaking before me very nicely. Thakur was talking about the cost of non-compliance, and Mr. Pradhan was talking about the recent changes in the regulatory context. I am given an opportunity to talk about, what are all the challenges we are facing in adopting these fast-changing regulations, and are there any practical solutions? Of course, I will be talking from my experience, and if each and every MFI has their own experiences, these experiences can be collated and which can be shared among the MFIs, so that or they can be codified into a sort of guidance, and which can be circulated to the MFIs for easy adoption. So moving on to my Next slide. Like November 2025 was a landmark time for all the regulated entities.
Sir, sir, could you please put it in a slide mode because your slides are not moving.
Is it
Yeah.
now?
Yes, sir.
No, can you put it on the
No,
slide
sir.
mode,
Sir,
PPT mode? This is showing the.
Sir, it will be better if you reshare.
Okay.
Now it's moving. But
Yeah, I am sharing again. Now I'm in.
Yeah.
I'm
Yeah.
putting in
It
slide
is-
share mode. Now the slides are moving.
Move to no presentation.
No,
mode.
sir, it's still it's not in the presentation mode, not slideshow.
Okay, but for me, I have already put it. I'm in the second slide. This is my first slide. This is my second slide.
Oh no, we are not
No,
able to
sir,
see
it's
it.
not moving.
Can you do one? Can you mail it to us immediately?
We can.
Yeah, I will do that. Ma'am, you repeat the mail ID?
HO.
HO.
Sir, ho@sadhan.org.
SADHAN. Sa-Dhan dot?
org. Sir, I'm putting it on the chat. अपना ही दे दे.
Yes. Sri, you can put it.
HO at.
On the chat, you please check chat.
Yeah, I'm checking, ma'am. I'm checking.
Sri at Sa-Dhan.org.
Sri at Sa-Dhan.org. I got that mail. I'm sharing it immediately. And I'm really sorry for this technical glitch.
Not an issue.
No, I don't like the friends waiting. I should have done it much earlier. Yeah, it's getting uploaded. In the meanwhile, I'll start speaking. I've sent it already. So the context in which I have been speaking is the challenges that the fast changing regulation that is brought on the MFIs. November 2028 is a landmark date in the life of all the regulated entities, wherein RBI has like repealed more than 9,000 piecemeal circulars and brought about entity specific and context specific regulations. In fact, on my analysis, I have prepared an analysis for my board. There were 35 master directions issued by DAR, which are applicable to NBFCs, of which at least 28 were really applicable to the MFIs. And the main or guiding circular for us is the one that is credit facilities direction and responsible business directions. Of course, all other directions are impacting us in our functioning in one way or other. I think particularly for the small and medium MFIs, by now you are thorough with the credit facilities direction as well as responsible business directions and drawn your action plans or policies accordingly and started adopting that. And if you look at the major changes, governance direction also changed. KYC direction also, now we have got NBFC specific KYC directions. And other two statutes which are coming in our way are DPDP Act and, as rightly pointed out by the previous speakers, the labor codes. These are all the major and sweeping changes each and every MFI is expected to understand, adapt, make policies, make SOPs, put them into practice, change their systems. This is a real big task. And I think by now we could have either done it or on the way of doing it. And as rightly pointed out my previous speakers, most of us are now facing either on-site or off-site RBI inspection for the balance sheets as of our financial position of as of 31/3/2026. And I understand the changes in qualifying asset ratio is now very big support for the MFIs because, yeah, now it has come. Ma'am, you can go to the second slide. Yeah, this is where we are speaking now. Second slide. Yeah, stay here. So we have to really understand that this is a very great change. We got entity specific and activity specific, context specific regulations now. The compliance team, it is a very big responsibility in your organization to ensure that these instructions are properly understood, codified, and they are put into policies and they are actually adopted, and your systems and rule engines are accordingly changed. Next slide, please. Yeah. So if you look at what really changed, see, if you look at, pre-consolidation, this microfinance lending and fire was a standalone. Now there is a strict 50% fire limit as well as household income limit of 3 lakhs. And digital sourcing also, there are strict guidelines. And pricing and KFS, now the KFS is standardized, APR is mandatory, and corporate governance best practice norms, they are now coming into play. Next. Next slide, please. Yeah. Can we move on to the... yes. So the real challenge now before us, in fact, the Sa-Dhan has to play a big role here, is household capacity assessment or income assessment, which can withstand RBI audits. More or less, we are following the same practice. We are pulling out CIC data, and we are also conducting a manual assessment. But how we are doing it? In fact, RBI accuses MFIs that, we are ensuring that somehow the family income is 3 lakhs in the personal discussions where we are documenting their, and also, irrespective of what is available in the CIC, we are ensuring that the fire is not exceeding in the in our income and household capacity assessment. So here we have to really standardize. For the standardization, we are really looking up for Sa-Dhan, that you may kindly, ensure that standard templates are put into place and adopted by the MFIs, and MFIs are hand-holded to adopt these templates meticulously. Next, please. You are in which slide?
The digital sourcing.
Yeah, coming to that. Yeah. So, if you look at digital sourcing, once again, lending service provided guidelines are very strict, compliances are very strict, and now the consent management is also coming into play because of the DPDP Act. So, each and every borrower or co-borrower you are having, there shall be proper consent and, standardization of, even in digital mode, pricing, transparency, standardization of KFS and APR, everything shall be very transparent. Next. So for smaller MFIs, what are all the challenges if you look at no? One, as we have already discussed, the income assessment and making correct APR. But the second and a very important factor is that the cost of technology. And today, without technology, no regulated entity can operate. And we are now using API for each and every activity. And the cost is, like a real cost of concern for all of us. And next one is governance. If you look at the governance side, data analytics to understand which direction business and risks are moving and how to price our loans, how to price our premiums, and how to have a proper working so that RBI will not blame us as usurious, and all those things are little proving to be tough for the small and medium MFIs. Yeah. Next. So there are few suggestions where we can have small and cost-effective interventions for operational conveniences. One is that, like income assessment. Income assessment way, here only, I would like Sa-Dhan to look at the first row mid box. You have to help us in benchmarking the income templates. And you have to ensure that our teams are adopting this. Of course, we can have a sort of committee, we can sit together and we can analyze and we can standardize, we can adopt. That is one thing. Then the second part is that once the standardized assessment templates are put in place, then it has to be cross-checked. To what extent it has to be cross-checked? 10%, 20%, 50%, 100%. It can vary based on our standardization by the next level officers like branch head or assistant branch head and all that. So the next one is the APR. What we are suggesting is that now it is possible to digitize the KFS and automated IVR based KFS can be pushed to the borrowers' phones. So we have an audit log and they can also understand what is the contents of the KFS, what is the cost and what is the annual percentage rate. Next. So software as a service may help us in ensuring that regulatory compliance is ensured as well as cost is reduced. So one way is that we are all having the loan origination systems. This loan origination system is old legacy loan origination systems are proving to be a stumbling block for a lot of small and medium MFIs because today everything has changed. And they are unable to upgrade themselves because of the cost. But I will strongly recommend and suggest that we have to really move into the latest technology, scalable MFI specific CBS systems and avoid our custom bills. Because continuing with that is going to increase our cost because every time we'll be going on, keeping on changing. That is one thing. When you are changing, many of the MFIs, I understand you don't have a UAT, UAT provisions. So test environments. So we will be rolling out without UAT and you will actually end up in mistakes, then correcting it and all that. So instead, this is a time where we can upgrade ourselves to scalable as well as MFI specific CBS. For that also, SRO can play a vital role in identifying, empaneling people, because IBA does that. Whenever new technology is introduced for all the banks, IBA does that. Here, SRO can help us. Then often our interest rates, though we are doing doorstep banking, and the cost is really very prohibitive because we are going lending loans at the doorsteps and collecting at the doorsteps, following at them at doorsteps. That is why our cost is more. But if we are not going to maintain our working, in fact, I have after starting this session, I thought I should also give you some insights on interest rate working. There are some slides I have added in the last moment that also we can see. So, your risk premium and your interest rate working should be very transparent, auditable. What you have got, your board or ALCO, whatever they have cleared or whatever interest rate they have approved, that should be, your machine should be calculating that, charging that. If there is a difference, then certainly RBI is going to find fault with you and it's going to tell you that you are, charging usurious pricing. So you have to be very, very careful in that. All compliance teams should check what ALCO has permitted, whether the same working has gone into your engines, so that is CBS core banking, and actually the same thing is charged to the borrowers. And the same thing is reflecting in your KFS. Then the next biggest problem we are facing is that the responsible business conduct issues, particularly with relating to the collections. Collections, timing violations, use of abusive language, and pressurizing them, threatening them, all those things are happening. And a lot of complaints are also originating both to SROs, to banking ombudsman, to us directly also. So ensure that, targets are important, but achieving targets both in disbursement as well as recovery in a qualitative manner is very, very important. For that, the training system in the MFIs, for smaller MFIs, SRO can chip in. That is very, 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 very important. The person in the field, is your eyes and ears, and they should be properly taught to behave ethically and as per the norms. In most of the MFIs, I find this is a big gap. The corporate office is super good. You have fantastic policies. You have a fantastic board, fantastic CXOs. You really do it, in a fantastic manner. But what your field staff understand about your policy, about your norms, about your fair practice code is very, very important, because that is going to be the image of you. In fact, SRO is periodically visiting the branches and trying to analyze. They are trying to conduct state level meetings and sensitize, but we want more. Unless our field staff are trained, unless our field staff are having the knowledge and awareness, unless our field staff are going to behave ethically, it is really going to be very difficult for all of us, because though we are headstrong, if the bottom is going to be weak, we will be termed as weak people only, and ultimately will be ending up with a lot of complaints. Next slide, please. So we have two SROs, right? We all understand Sa-Dhan and MFIN. Sa-Dhan is doing a real good work. I have recently attended one of their meetings at CEO's meeting at Mumbai also, where the latest Sankalp 3.0 was adopted. And they have to help us in certain areas. Like I was already telling, now IT-based audits, that is becoming a real touchy issue for MFIs because of the cost. So here, whether the SRO can help us in pooling the IT audits from the external vendors, so that the expected granularity will be reflected in the audits, as well as the cost is limited. Then The second one, I am expecting the support from SROs is that, like your guidance note, code of conduct, Sangal, whatever you call it, particularly your training module and standardization of our templates. See, MFI, like here, the activity is a small activity only. Only one thing, you have to catch the borrowers who are having 3 lakhs and who can fulfill 50% fire norms within the the regulated RBI guidelines. So further, the activity is limited. One is sourcing the borrower, second is documentation, third one is recovery. For that, we have to have a definite code of conducts, definite modules, definite templates, and lot of training to the field level people. One more thing is that our attrition rate is also reasonably high in the field level. I think it is applicable to all MFIs, I think. So the thing is that when people are floating, when your field level people are coming new and frequently they are getting changed, like sensitizing them continuously is very, very important. So training and awareness building is a very key activity in which we are expecting support from SRO. And the next one is what we are doing, continuous peer sharing. Like the best practices shall be, without any hesitation, shall be, though we are competing with each other in the field, we should responsibly grow ourselves in a very, very compliant manner. For that, the peer sharing of issues, challenges, best practices is a must. And SRO role in this regard, like it is very much expected. Next slide, please. So, as my previous speakers were telling, compliance is now the state of art thing. So, you have to have an active board oversight, and we have to bring in smart technologies, and we have to ensure ethical staff conduct. If these 3 things are ensured, I'm really sure that MFIs can grow, scale ourselves in a very, very successful manner without getting penalties or problems. Next slide, please. So this one, I wanted to just a few slides. With the permission of, though I'm exceeding time, hope Gigi sir will permit me to show a few more slides.
Yeah, please carry on. Please carry on. Go ahead.
This is the recent IO directions. This is applicable for MFIs 5,000 crores and above. And one of my previous speakers was also talking about a deputy IO. Deputy IO, it is an option of the MFI, but now the IOs can work in more than one regulated entities simultaneously also. That also you should know. But once IO comes, our grievance redressal mechanisms should have an auto escalation for partially resolved and wholly rejected complaints. And now RBI expect us to have 20 days for ourselves, 10 days for IO. Of course, if IO gives you a verdict which is against the organization, you can go to your apex authorities like MD or ED, as the case may be, as per your policy. And you can also have a relook. But I'm strictly telling you, if you are getting some complaint escalated from banking ombudsman, then they will also ask you when you received, when you examined, and when you have given a solution, whether the solution was some comment is coming, which I will talk later. So this is very, very important. I think now he can also issue advisories to the regulated entities in line with the BO, for which we should have something inbuilt in our policy also. Next slide, please. Can we move to the next slide? Yeah.
Yes, sir.
Yeah. It has come. Now this is going to be operational from July 1st, 2026. Already you are aware, they are one nation, one ombudsman. That means Tamil Nadu compliance can be dealt with by ombudsman in Rajasthan also. And now the deficiency in service scope is expanded. And there are strict timelines for them for the complainant also to approach BO. And the biggest problem which we may be facing is that if there are any sort of monetary related complaints, disputes, and and if it is proved that we have deficiency, there is no monetary cap on them for them to look into the complaint dispute. And their penalty powers have been increased, 30 lakhs and 3 lakhs. 30 lakhs for consequential financial loss and 3 lakhs for harassment. This is, I think, going forward, we will see a lot of activism from BOs. So here also, SROs have to play a role in particularly hand-holding the small and medium MFIs on how to, strengthening their compliant redressal, grievance redressal mechanisms. And a data consent mandate also has come into play now. Next slide, please. Yeah, this you may be aware, this is our existing NPA framework that we are all aware. We have substandard, doubtful, and loss categories. Before that, we have SMA 1, 2, 3. Now, move on to the next. Yeah, now this is the challenge. I think all of you would have adopted this ECL model, where we have stage 1, stage 2, stage 3. I hope every one of you would have already created policies and adopted the Ind AS based asset classification norms. Please, next slide, please. Yeah, here the issues that the regulatory mandate is higher of the two we have to adopt provisions. This is going to be a catch. This may affect your profitabilities also going forward. Next slide, please. Yeah, we were talking a lot about pricing. See, this is your pricing formula: cost of funds, operational expenses, expected loss or provisioning cost, risk premium, and your margin. You have to be very clear in documenting them. Very, very clear in documenting them. Your policy should be very clear. And whenever you are reviewing, I think all of us are lending on fixed rate of interest only. Nobody is giving floating rate of interest. And this has to be very carefully documented. And you should, compliance officers should ensure that not only your policy, your system also charges the same. Next slide, please. See, this is an indicative band for your cost of funds for a typical MFI, operational expenses, loan loss provisions, risk premiums. So according to your efficiency, everything is mostly decided by your cost of funds first, then operational expenses. Your loan loss provisioning is based on your efficiency only. The cost of funds is the efficiency at which, the rate at which you borrow, you mobilize funds. It may be from banks, it may be from NBFC borrowings, it may be CDs, it may be CPs, it may be ECBs. Now, like the lesser rate of interest of your borrowing, your overall cost may come down. And that cost of fund is decided by the lender based on your qualities, your rating. So if you are going to be efficient, then naturally the cost of fund is going to come down, and ultimately your final rate of interest is going to come down. Ultimately, you're going to be competitive, but still you will be retaining your margin. Okay, this is one of the very key things I wanted to discuss with you today. Yeah, I think that's all. You can close the presentation. Once again, Gigi, thank you very much for this opportunity to share my thoughts with the team. MFI is a very vibrant segment. I came from a public sector. I'm a retired PSB CCO, joined recently in MFI. For me, it's a good experience. I see a lot of green shoots in MFI segments, and we have a lot of scope. This is one of the very important segments of fulfilling the needs of a very vulnerable section of the society. This segment has to be protected. To protect that, all of us have to be very, very disciplined. We have to listen to the regulator. I think my peer Panda is here, my senior. Panda ji, namaste. Yeah, we have to be very, very disciplined. We have to, like we should never think about short-term gains. We should think about long-term gains, not only for us, for the industry. With this, once again, I thank everyone for the patient listening. And if there are any questions, I'm willing to take. Thank you.
Thank you, sir. There are a few questions. I'll read out them. One is this is from Ekta. She is asking she is a shareholding structure of Surya Company NBFC. XYZ hold 10% equity shares directly. Kiran Co holds 9% directly. XYZ holds 16% equity share in Kiran Co. According to XYZ, indirect economic interest in Surya Co. through Kiran Co. works out to 1.4%, 16 into 9%. Process transaction. Surya Co. propose to make a further allotment of equity share to Kiran Co, which may result in Kiran Co's shareholding in Surya Co crossing the 26% share threshold prescribed under the RBI Master Direction NBFCs.
Ma'am, I will suggest you send it across. I will examine and give, because this is looking like a sort of, we have to really understand this question. Anyway, it is very interesting because we have to look at SEBI perspective also into this. Today, all of us, we were speaking mostly about RBI directives, but there are other things also. SEBI is there. So we'll look into that. You kindly send it across. I'll be able to study it and give you a clarity on that. I don't think this can be clarified across the table. Thank you. You can move to the next
Sure.
one.
Do that. There is another one from Supratim Jagran. He is asking that the company there is an under RBI direction of KYC, which has been issued on December 29, 2025. The company shall ensure that the authorized officer takes a live photograph of the customer and embeds the same photograph in the customer application form. Further, the company's system application shall put a watermark in a reliable form containing customer application form number, JPS coordinates, authorized official's name, unique employee code, etc. On the captured live photograph, it has to be. So his question is that PAN has made mandatory. Any insight on this?
Point number one, I think there are many ways you can onboard a customer. One is physical, which most of us are doing. Second one is, OTP based authentication, in which, one of my representative will go to the field and he will see the beneficiary and he will capture it in the machine. And in that, liveliness check is very important. And also the GPS coordinates have to be captured. And we have to also capture who is my officer holding the device and capturing. So all these things are coming when not in my premise, when they are going and capturing in the field. And there they have to prove that the valid OVD they are having, that also they have to capture. The next one is your video KYC. So in which mode you are going to onboard the client, customer, based on that the technology will vary. Then it's a very interesting question. I am coming to PAN. PAN, no, as a best practice, we are trying to capture it. But in my opinion, for MFIs, for our kind of transaction, I don't think PAN is mandatory. I think SRO can, or anybody else can clarify, because IT rule 114B says, IT rule 114B says that it will be 5 minutes because I'm in the session. After that, we can have it. So sorry for the disturbance. If your transactions, first thing is cash. Here, the disbursement is going to take place to the verified account number of the beneficiary digitally. I don't think any MFI is disbursing a cash. So cash wise, even CTRs we are not going to have. The second part is collection. In the collection also, our EPIs or EMIs, whatever you call, is very small. And if collected doorstep, we are now encouraging people to adopt digital methods. collected at doorsteps, no, and I don't think per beneficiary it is going to exceed 2 lakhs per year, even if prepayment is made, pre-closure is made, because our loan limits are lesser. Overall indebtedness cap is around 2 lakhs only, and we are not going to lend to 2 lakhs. So in my understanding, this even the either earlier Form 60 or now Form 97 may not be required, because the threshold transactional breach either in cash or in the volume is not going to happen for our beneficiaries, is the understanding. If any other seniors like Pandaji or any other persons have different opinion, you can tell here.
Sir,
I'll just clarify what SRO's point of view is that we had suggested that as far as possible, MFI should move into collecting PAN. When it is a suggestion we gave, we said that we encourage the MFIs to go into that, mainly because Aadhaar as a common ID, MFI is not able to, they can do eKYC, but probably when you submit the data to the credit bureaus, you can't do that.
just
So again, you have to download some voter ID or some other thing. So we said, if we can move, if a situation comes that all the borrowers PAN ID is available, then probably that would be a better way of reporting and getting the data and deduplicated in a better way.
Gigi
just
sir,
to
you
add
are
on to the
exactly on the
Sa-Dhan.
spot. One
Yeah.
sec. Gigi sir, you are exactly on the spot. In fact, if you look at our CIC data submission, we are about 93% clients we are able to collect PANs. Today, PAN is available. It's a best practice. Moreover, no, like Aadhaar now we are submitting in a master form to CIC. I think we are not submitting full Aadhaar. So they somehow require a secondary ID for matching as well as for data pulling. Voter ID is one possibility. Now after the SIR, we have a lot of challenges with the voter ID, and PAN. It is very much available. We will be thinking that no, like we are dealing with bottom of pyramid people. They may not have PAN, but surprisingly, we find that no, like our level of PAN collection is about 93%. So it should be available.
Oh, that's great.
And
Add
it's
on
a
to that,
best
sir, I
practice
think,
as suggested.
yeah. So I think PAN is
Yeah,
not
but then,
OVD. Just to add on to this, PAN is also, as you all aware, that this is not an official valid ID document. But in the KYC directions, PAN or declaration, that has to be, because in the CDD process, it is a mandatory steps. There is no exemptions for MFI or any cash, a particular amount ceiling. There is no a particular amount ceiling for not having this declaration or PAN in the CDD process. So I request NBFC MFI to follow that practice. In the application form, they can put an option kind of yes or no. In case the customer has a PAN number, yes, then add PAN number. In case no, then the Form 60 declarations can be embedded to the application form.
We will deliberate
Yeah.
and we will write to Sa-Dhan, so that no, like a common
yes.
stand can be taken and issued. We will also
And
consult tax
just to add on to
consultant.
that,
Yeah.
sir, just to add on to that, this observation has already been come up with few NBFC MFI's inspection reports. So
No, the
for
inspection report observations can be countered. For example, gold loan. Gold loan. What is the SRO guidance? To take only 1.5% of interest. But some MFIs, I understand RBI said, take the total limit divided by 12 plus add the interest component.
so
As
it's up
we,
to NBFC MFI. I'm not suggesting any kind
no,
of
no,
thing.
no, no. RBI has
Just
specifically said to
mentioning
few
that
MFIs, I have
that
these things.
yes.
Yeah, I think we have to, Gigi sir, I think I have to leave. I have another engagement. If one or two questions we can take
Yeah.
and we can.
Yeah, let's see. There's any other question?
There is only one question, that the cost of fund if there is no borrowed fund. What would be the cost of fund if there is no borrowed fund?
Very valuable question. You have a capital, no? For the any other, like I'm literally blown. I have never imagined such a situation. Of course, there may be smallest MFIs where they could have put their own funds. So someone can throw a light on how to give arrive the cost for the own fund when there is zero borrowing.
See, basically, you have to, as you rightly said, Sureshji, see, the own fund also has a cost.
Yes.
There's an opportunity cost for the funds. So if you are having own funds, if you are not deploying into this business, you would have been putting it in some other form.
Yes.
What could be the opportunity cost of that particular
fund? Yeah.
So that you have to take a call. I mean, you can't prescribe that this should be this much. It is your choice, your call, but then there's an opportunity cost.
Exactly.
Yeah, I think Pandit is trying to say something.
Yeah. In fact, as my friend Mr. Suresh Kumar was telling, it will be very rare case where the entire funding is through equity. And equity, in fact, is a high cost compared to debt. In fact, debt management equity holders should be advised to leverage their equity and raise debt, which is cost is less. Average, in fact, the cost of equity generally should be minimum 15%. So that high cost of equity, in fact, will increase the cost of lending. They have to reduce it. They cannot do it like that. They should leverage this funding through the debt. Debt is always cheaper than equity.
Right.
So there is another question for Suresh sir and Subrat sir. Aadhaar full 12 digit to be reported as per UCRF guideline for CIC's reporting.
CIC will not.
So is there any advice on that?
No, CIC,
How to report this Aadhaar number on CIC common reporting format?
in case of NBFCs, the Aadhaar number reporting is not possible in the CICs. In fact, we were asking,
Yes.
I don't know how Suresh was telling us you are reporting with mask, because that is also, as I know, it is also not available for NBFCs.
Yes, sir.
So I hope that
Yes.
answered the question.
Yes, for the
One more
NBFC.
suggestion is, ma'am, that you can pool all the queries and send it to us. Like we can analyze and give a view that you can vet it and recirculate.
We'll circulate the question with both the speakers. Thank you very
And before
much.
that, can I request Subrat, if you can, if it is possible, you share your presentation.
I just
presentation.
shared that PPT with
And Suresh and Subrat, can we share this to the participants?
Yeah, absolutely
Yes,
not,
yes.
sir. It's a literature only now. There is no confidentiality in that.
So
Yeah.
we'll be sharing.
Thank you.
Thank you, sir. Thank you. Now I'll request Chandan Thakur to share a closing remark and conclude the webinar for today.
Well, thanks, Dee, and it has been really quite insightful and exciting webinar. And for last almost 75 minutes, we discussed on the various impact. I mean, the impact of compliance and the impact of non-compliance, and we're really thankful to both our speaker. Like they brought quite different perspective. Mr. Subrat Pradhan on the recent key changes in regulation and their impact, and Mr. S. Suresh Kumar on the challenges of adapting to key regulatory changes. I mean, really insightful slides and discussion on this. And I'm sure, in a nutshell, we all know that MFI sector, that and we really look for the compliance part. RBI really look up to us. We all know we serve the underprivileged community. We are always prone to external factors, some political issues, and also for us, it becomes more important to stick with the guideline, to follow the compliance. That's important for all of us as an institution and as a sector at large. And certainly we hope to engage at regular interval on such insightful discussion where we would have our member institution as highlighted by Mr. Suresh Kumar there. I mean, he has assigned us a lot of tasks, and being an SRO, we will be happy to take it forward, particularly at a sectoral level. And all the points are quite insightful in terms of the new rules like DPDP Act and this HR code. And also, certainly, we have to pull our socks, and we need to ensure that we stick with the guidelines. But we really hope to maybe at every quarter, we would like to have, or maybe 6 monthly, something sort of that, to have a similar sort of webinar where we can discuss the new regulatory guidelines, the challenges in terms of the implementation. That will also help us to take something to the RBI if there is any issues, and also that really we look forward to your support. And we always urge our members to please keep us posted if there are any issues in terms of the compliances at ground level or anywhere. We will be happy to work together and make our sector really, that ideal ecosystem. So thank you so much. Thank you everyone for joining the webinar. It's really helpful. Thank you so much. Have a good evening.
Thank you, Chandra.
Thank you. Thank you. Thank you, sir. Can we log off?
Thank you, everyone.
Right,
Thank
thank
you.
you.
It's Indian Bank, huh? Indian Bank GM, huh? When he retired?
1 year back.
Oh, new. Immediately important, huh? There are some people getting employment, huh? There are some people, no? Some bankers getting employment, huh? Not all of them, is that?
Not all. He was the chief compliance officer for Indian Bank.
He was, huh? And then it is here, the senior is there.